Hi, everyone. Thanks for taking the time to tune in to our latest market update video. For those of you who don't know me, my name is Nicole Serio. I'm a senior client associate and next generation advisor on the team. I'm here with senior financial advisors Kevin Wager and Thomas Macaluso, as well as chief investment officer Jeremiah Reith-Miller. To kick us off, Kevin, with the war in Iran, can you kind of give us an update on where markets stand today?
Yeah, Nicole, absolutely. So this year's definitely been more choppy than the previous couple of years. And based on all the recent headlines with the geopolitical conflict that's happening, I think it's fair to say that you might think that the market will be down a lot more than it really is. So I just wanted to share kind of where current levels are and then some, historical context on those levels. So the S&P 500 year to date down about 3 or 4%, and from the previous high, which is around S&P market level of about 7,000 and change, to its recent low, which is about 6,400. The S&P is down about 7% peak to trough. So and bonds are actually holding up pretty well. So if you look at the bond market, down just about less than 1% for the year. So to put that into perspective, down 7% peak to trough, that's technically not even correction territory. So when the market goes through correction, that means it's down 10+%. And additionally, one of the charts that we love sharing with clients during review meetings just shows some historical perspective going back to 1980. And it shows the intra-year pullbacks and where markets finish for the year. And on average, markets tend to pull back more than 14%. So again, I think despite what we might be feeling and with the headlines and everything, the markets are in a pretty decent place. And I think additionally, maybe zooming in or zooming out, but a little bit more narrow to the last 3 years, I think it's important for investors to remember that the last 3 years were actually abnormally very good. If you coming off of 2022, 23 and 24 were 20+% years, and then last year finished up 16. So, if you go back 100 years, the rolling decades, stocks usually get you high single digits. And like I mentioned, the last 3 years have been abnormally good. So coming off of last year, we did expect we did anticipate more volatility and maybe more and more normal return environment, although still cautiously optimistic, things are in a pretty decent place. So I think the message to convey to investors and our clients is that despite some really seemingly relentless bad news that continues to come out, markets are still doing pretty well.
Thanks,
I just
Kevin.
want to add a couple stats to that, Kevin, because I think the data is interesting.
Sure.
We went back and looked at this last week. You look at the VIX, which volatility index we've talked about in the past videos that we monitor for those sort of panic spikes. We've seen the VIX spike pre-markets over 30, which is sort of the metric that we look at as that first sort of panic trigger level. But then those subsequent days, because of the news headlines and how the news has changed so quickly, markets have been relatively resilient. The other thing that was surprising to me was that the worst day that we've had since this all started in the S&P 500 is we were only down 1.5% on a given day. That's not, it's a little elevated in terms of the volatility of the market, but the big days aren't until you're -2.5, really. So to be our worst day, only -1.5, and to your point, those year to date and since the peak numbers, not really that meaningful, I think speaks to your statistics about the geopolitical tensions. These events tend to be relatively short-lived as it relates to market movements.
Yeah.
Tom, I was wondering if you could kind of share on how the current market environment has impacted earnings and what you're seeing as it relates to fundamentals and valuations.
Yeah, thanks, Nicole. And I know there's a lot going on in the headline news right now, whether it's the war in Iran, private credit. I gotta say the biggest metric that we track is the S&P 500 and their earnings. And right now, revisions to anticipated first quarter earnings, which we're still in the first quarter, it'll end at the end of March, and the earnings season kind of kicks off at the beginning of April. The earning expectations have been fairly unchanged. That year over year right now, we're expecting a 12.5% increase on margins compared to this time last year. And if that holds true, that's going to be 6 consecutive quarters or a year and a half of increasing profit margins. So despite what seems to be some elevated headwinds right now, we're still looking at a very robust market. And then to kind of second what Kevin and Jeremiah have been alluding to is overall the market is very healthy. You do have the top 10 stocks in the S&P that are down about 10% this year, but the other 490 stocks, they're about flat, which suggests that the index is coming down a little bit, but that the average stock is holding up just fine. And this is also allowing price to earnings. The expensiveness of the stock market has been coming down because you have a price level that's slightly declining, but you have earnings, the denominator, that is going up. So you're beginning to get a more attractive stock market to invest in. And I think this is relatively healthy, everything that has taken place as far as the market action this year.
Thanks, Tom. I think that's kind of a good transition into, what our team is watching and how we're thinking of positioning. Jared, would you mind elaborating on that?
Yeah, one asset class that is have been in the headlines and has been volatile, very volatile, has been oil, and I think that's important to understand. We've seen oil intraday move up to 120, almost down to 80. We're sitting around $100 a barrel right now. So that price volatility has been obviously abnormal. One of the other things that's interesting as it relates to oil pricing is you'll notice Brent crude oil versus West Texas Intermediate. So the important difference here is obviously West Texas, that's a US base price oil. Brent is global. So when you look at the spread, usually these trade pretty closely. But right now there's about a 10% difference, $10, which is now about a 10% difference between those pricings. And I think that tells us a lot about the global impact of this versus US impact. So as we think forward, regardless of the amount of time that this war takes, whether it's short or long, there will be some sort of economic impact to the global economy. You've seen the Federal Reserves globally talking about this impact potentially in inflation and how that affects rate policies. Our Fed met their last meeting. The market is basically priced that there's no longer any interest rate cuts expected for 2026. It's quite possible the market is suggesting there's rate increases to help fight potential inflation that may be coming as it relates to oil. So sort of repositioning of Federal Reserve banks as it relates to rate impacts, I think, is important to understand. And historically, the U.S., as it relates to energy, is better positioned to sort of weather these storms. And we're seeing that, I think, play out in that West Texas Intermediate versus Brent pricing. So as we think of positioning, this to us suggests maybe taking more of a U.S. bias. Last year, we were more overweight international stocks. In January, we actually added to international in the form of specifically global infrastructure, which year to date, that's up 4%. That's fair to okay. And I think this will actually be a catalyst for additional investment in that space. So we're maintaining that exposure, but that global and international dedicated allocation that's more broad, moving that back to the U.S., at least for the next 6 to 9 months, as we sort of get through this sort of economic impact. And then to Tom's point, why now? Obviously the impact of inflation, but to Tom's point, valuations looked more attractive. The market, that large cap space, has gotten a little healthier with those top 10 stocks selling off. So we like the diversification there a little bit better. So that to us all suggests that moving some of that international exposure back to US right now makes sense in our model portfolios.
Yeah, with the top 10 stocks not doing so well, their concentration in the stock market in the S&P 500's actually dropped from about 43% to 38. So it's not as top heavy as it was at the start of the year.
Still very heavy, but
I know.
It's all relative, right? It's not as bad. PEs were at 22; they're below 20. It's still kind of elevated, but with more within a reasonable level
Sure.
that we like at this point.
Well, thanks for watching our market update video. As always, please feel welcome to reach out to our team with any questions.